Welcome back to our assessing options for drought response presentations. Okay, this one's about selling, feeding or agisting PTIC cows. It's number 4 in the 7 presentations. So what have we looked at so far in these presentations? We've counted and assessed the herd and the pasture, got our minds around our situation. We completed that, put it together. Then we assessed our mortality risk and the potential actions we need to take there. We looked at early weaning, and that gave us a bit of a situation analysis that we need to revisit now. So we looked at our herd and we got this PTIC empty cows, which there's not a lot of them, but they're an easy target. Now, if you don't preg test, you don't identify these cows. So this is a key outcome of having an effective pregnancy testing process, that you can understand the nature of this PTIC empty problem. Then we've got our PTE cows, which we said we need to keep a lot of these to keep our weaners coming through the year after next, because we've got this mating every second year problem in a lot of these more mature cows because of the low nutrition of our pastures. And they do, we could clean them out, but they create long-term problems. Then we've got our core breeder herd, our PTIC cows and the heifers coming through. There's a fair proportion of them. They provide next year weaners, but they're going to require feeding. So this is the sort of situation we decided we had. So let's look at that last lot, the sell, feed or agist PTIC cows. Now, this is a really critical question. Normally, you don't look at these cows, but we're going to look at them first. Because it's really important that you're right on the ball and you consider all options. And these are an option that's considered last, and last is too late. So we're going to do it now. So there's a limited amount of time in which to make this decision, so we're going to look at it now. So we will use a specific tool designed to consider this question. And the question is, if we want to maintain our weaner numbers over time, is it better to sell the cows and buy them back, or feed them, or put them on agistment and then bring them back? So that's the choice we're looking at. Sell PTIC cows with later repurchase of PTIC cows and calves. That's it. This maintains, the idea is to maintain the expected output of the breeding herd over time. We want to stay in business. We want to minimise the cost of the drought, but we know we've got to make a significant reduction in grazing pressure in the short term after this failed wet season. Let's look at the difficult questions first. This is very risky. These are our core breeders. So one approach to assessing this decision is to compare the costs, only the costs, of keeping the PTIC cows with the expected costs of replacing them at a later date. So it's compare selling and repurchasing the cows. There's a balancing act going on here, versus feeding them at home, or selling and repurchasing the cows versus sending them on agistment. So that's the balancing act that we're considering. Now, of course, there's always a spreadsheet involved in these things, but the process is to identify what the cows are currently worth. We add the costs of holding the cows, either feeding them or agisting them. We compare this cost to the cost of selling and repurchasing cows and calves at a later date to get our herd back into production. Into this process, we've got to incorporate the livestock inventory value change. So we've got cows and calves coming and going here, and we want to get back to the same position. So we've got to take into account the inventory value of our livestock over time in this calculation. Put together a spreadsheet. It's available on our Future Beef homepage. Let's just open it up. It's called Feed or Sell PTIC Cows. Let's see if we can get it to open and have a quick look at it. Everything in yellow is where you enter the data as usual. This is called a calculator for comparing drought feeding PTIC cows and selling them, or selling them and buying them back as cows and calves. So there's a sort of a vertical calculation set of boxes there, and over here to the right there's some other boxes that you can put stuff in to help with the calculations. And there's a box here for calculating the value of the owned stock on the farm. So if the point of sale is not the farm, if you've got to take them to the yards and sell them, the selling costs have got to come out to get the value on farm. Transport cost per head calculator. So how many dollars is it going to cost us to send them to sale? And here's our transport loading density guide to give us a ready reckoner of how many are going to get on a 12.2 metre deck to allow us to put our costs together. So let's start at the top, and we just follow the process down. It's our North Queensland Gulf property. The cattle, we're looking at assessing here our PTIC cows. Over the year, there's going to be about 500 of them that we can consider selling. And at this point in time, we're going to pretend on May the 1st, we could sell them. So remember, this is the wet season fails. We're making these decisions in February, March to think about our options. So, okay, by May the 1st, right, we could cash these cows, PTICs, they're all going to be separate, and we need to replace them to keep our weaner numbers going. So 12 months later, on the 30th of April, we need to buy them back. So we could sell them or buy them back. So the days they're gone is 365. Their current live weight in the paddock is 450. Their current value in the paddock is $1.76. How did we work that out? Well, okay, we came over to this box, calculate the value of the owned stock on the farm. They're 450 in the paddock. They're going to lose a bit of weight getting them to the yards. They're worth $2 in the yards. It gives us a gross sale price. We've got to take a bit of commission out of that. We've got to take some yard fees and transaction levies out of that. We've got to get them to the yard. So we worked out our transport cost down here and copied it in there. So our cows net selling expenses are worth $7.91, and if you divide it by their paddock weight, comes up at about $1.76. So the $1.76 goes in there, and you can see I've just put it there as a formula, so it comes straight across. So okay, we could cash these cows and put $395,000 in the bank basically, and that's the capital to buy them back later. Now, if we cash them, so no, that establishes their value at the start. Then we want to think about the treatment costs of holding them. So there's 500 of them in the mob. We're going to have to feed them for about 26 weeks, considerable period of time. It's a serious drought we're in. If we feed them, we expect them to eat about 1% of their body weight, which is about 4.5 kilos of this supplement a day. $400 a tonne landed on the farm, so they're going to eat $164,000 worth of food to keep them going. We're going to feed that supplement out a couple of times a week at $50 for wages and fuel. There's a couple of $1,000 there in feeding costs. So we've got a total supplement and feeding out cost. Then to that we add some health costs because we've still got them on the property. We've got to, if we sell them, we don't incur the health costs. We're probably going to have some other normal supplement costs in terms of something in addition to this energy ration. So there's probably some phosphorus and stuff that's got to go in as well. Normal feeding ration. So our total treatment costs of holding is about $180,000. Now there's an opportunity cost, which is what we have foregone in terms of capacity to earn interest on the money that we could have put in the bank if we'd have sold and put that money in the bank for 12 months. So let's say 5% is what the opportunity cost is. We could take that money, take it off our overdraft or our working account and effectively save that. So on the amount of the money in the cattle, there's about 20 grand there that we could have effectively included as an opportunity cost. And if we keep them at home and feed them, we're going to have to pay interest over time on that money that we've spent on food, and we only charge it at half the rate, but there's another $4,500 there in probably interest costs on feeding them. Now, we only need next year, because we're going to lose 10% of our calves, just as pregnancy post-conception losses. So we only need to replace 450 cows and 450 calves. So our weaning rate we expect to be 90% of the cows that we retain of the 500. That gives us 450. We expect a mortality rate on top of that of about 5%, which means At the end of this period, we're going to have 25 empty cows. Of the cows that we hold on farm, they're going to be sold anyway, so we will balance them out of this cost calculation because we don't need to replace them. We only need to replace the 450. So we balance that out and says, okay, the value cost of cow and calf units at the end of the period, if we hold them and feed them, is about 580,000. Now, this box down here calculates the expected costs of replacing them if we sell them. So we only need 450. We're going to have to spend a little bit of money to travel around the countryside finding these cows. That gives us $3.33 a head, $1,500. We know we've got to transport them back to the property, 500k. There's our cost of getting them back to the property. We probably got to spend some money on them to settle them down on the property and get them going again. And then on top of that, we've got to pay for them. We expect about $1,200 for the cow and calf unit next year once we've had a decent wet season. So we're looking ahead to this April period where we want them back on the property. So we expect if there's a normal wet season next year, we can probably pick these cows up, equivalent cows, for about $1,200. Now, this is just the difference in cost calculation. So we've calculated the costs of holding them, including the inventory cost, and we've calculated the cost of replacing 450 cows and 450 calves next year to get us back to the position that we would have been if we'd have held them. So the difference between those two is minus $18,000. So that means the cost of holding them is greater than the cost of selling them and replacing them. So you're $18,000 on that example worse off if you held them compared to replacing them at $1,200 in 12 months' time. Now, we'd have down here a bit of a sensitivity table where we've got different selling costs now and different buy-back prices, and it gives us a bit of an indication of the sensitivity of this guess that we're making. So that's the spreadsheet. Let's just go back out and look at some of those results. And a negative number in this example, because it was just the difference between the two costs, and we decided to take this one from that one, and we got a negative number. So, expected cost of replacing cows and calves was about $1,250.83 by the time we added in our finding and transport costs. So, to get them back, we expected to spend $562. To hold them, including the opportunity cost and the feeding cost and the adjustment for the ones that we would sell anyway, was $580. So that is bigger than that. That take away that gives you a negative number. That's the lowest cost. That's the higher cost. The solution is to possibly think seriously about selling them at that $2 in the yards and then buying them back at $1,200 next year. Pretty risky. So this calculation is simply the difference in cost between the options. Our goal is to minimise the costs associated with the drought. That's the goal. We just want to keep this business in production and we want to get through the drought with the lowest cost possible. And we've got to take into account the value of the livestock asset and the need to maintain herd output over time. This sensitivity analysis, the break even for 500 cows, so we said $2 was what we expect, and we expected them to get back for $1,200. On that basis, it's probably better to sell them. Now, if it cost us $1,300 to get them back, it's probably better to hold them, and that's the value that you gain by holding them. If you think, oh, they're a really good price at the moment, I can get $2.40 for those cows, and I can probably buy them back real cheap. Well, you're significantly worse off. Yeah, but that's an outlier. And here, if you think, I've left a decision too late, I can only get $1.60 for them, and I expect for the same article to pay $1,500 next year, well, at the cost of feeding you expect, you're a long way further ahead holding them and feeding them. So remember, it's just the difference between the two options we're looking at. This is not profit or anything like that. It's just a difference in cost. And we've got to think about what that means in terms of the risk of the sale price now and the risk of getting those cows and calves back at a reasonable price. The spreadsheet's only useful where the choice is to feed the cows at home or sell the cows. So it's only got that limited use. Let's think about the other option of agistment at $3 per head per week. There's a spreadsheet done up, agist or sell PTIC cows. Now this is exactly the same as the other spreadsheet. It's got all exactly the same boxes, except the treatment costs of holding the PTIC cows are now agistment costs. They're not feeding costs. So in this case, I've just pulled out the calculations to cost the food and replaced them with calculations for agistment. So the agistment cost calculator, we're going to send the 500 on agistment. We are going to take it from May until January next year, the end of January next year, a lesser period because we think we can get them home at the end of January if there's a normal season. We've got to pay some freight to get them to the agistment point. So there's nearly $40,000 worth of freight to get them off the property. We've got to take them across the tick line. So we've got to treat them and we've got to pay some yard fees. And then it's going to cost us $3 per head per week for the agistment. So the agistment cost per head is at $117. But then we've got to add, they're away on another property, we've got to go and muster them and look after them, so that's probably $20 a head. And some costs associated with their normal supplementation program. We expect to put the normal supplements into them, so it's $25 there. Then we've got to get them home again, so there's another $75 a head to get them home. There's $160,000 in this agistment exercise. So it doesn't cost $117 per head for the agistment, it costs $317 a head for the agistment. Then we've got the opportunity cost again of foregoing the interest that we could save or earn on putting the sale value of these cattle in the bank, and we still only have to replace 450 at $1,200 a head. That's still our estimate if we don't agist them. So this is just the box where we work out if we don't agist them, what's the cost of replacing them. And again, we've got our little sensitivity box down here that if I close that and go back out, in this case, a positive number, it's the difference between the cost of sending them on agistment and the cost of selling them and replacing them. In this case, the expected cost of replacing the cows is still $12.50.83 as in the previous example. The value cost of agisting cows and calves at the end of the period is $12.40. That's lower. The difference is positive. So you'd say, okay, at $3 a head, if I can find good agistment until the end of January next year, it's probably worth considering, and I won't take the risk of selling them and trying to get them back. And again, at $3 a week, there's this sensitivity table of if you are forced into a situation where you sell them a little bit cheaper, you lose 40 cents a kilo on these PTIC cows because everybody's trying to offload, and you've got to buy them back at $1,200 still. You say, oh, well, hang on a minute. It's certainly better in that circumstance to send them on agistment. If you can sell them cheap and buy them back cheap, it's better to take that risk. So it's about balancing the risks in this circumstances. In this case, the positive number is the difference between the cost of one and the cost of the other, and it's better to slightly ambivalent about what you do there. $4 for the agistment instead of $3. The sensitivity there, okay, you put it up by 1/3 the cost of the agistment, which is quite often happens when you're going into a significant drought. You can see it's probably better to sell and buy back in that case, or think about it. If you think you can buy them back for $1,200, if you think it's going to cost you $1,300 to buy them back and you can only get $2 from now, the agistment at $4 per head per week probably becomes something you think about. So in summary, to sell, feed or agist PTIC cows, difficult decisions. Most of the comparisons indicates that if you understand the risk of and the cost of buying those cows back to get you back in the position where you were, where you've got your 450 cows and your 450 calves going into a weaning situation next year after the drought, there's little difference, and it's a bit of a balancing act. But if the market shifts either way, if there's a really good price for these PTIC cows and you think you can get them back at a reasonable price, well, you think about it. But it's very sensitive to the input costs and prices, and Obviously, risk plays a big part in the decision. It's necessary to keep in mind the horror stories of people who kept breeders and tried to feed them through the recent drought. And on that basis, you've got to remember that this little spreadsheet only is useful over a 12-month period. If you try to think about things for more than 12 months, where you might have another set of calves coming into the equation if you hold them and feed them, or extended capital feeding costs, you've got to go back to a cash flow and a longer term process of analysis. This spreadsheet doesn't help in that process at all. Okay, where to next? Send stale steers on agistment or sell early.